On a quiet trading morning in New York, a bank most Americans had never heard of failed. Not JP Morgan, not Goldman, not a Silicon Valley darling. A mid-sized UK mortgage lender. And yet, within minutes, Wall Street screens flickered red. Credit spreads widened. Bank stocks dipped. Traders who couldn't point to Birmingham on a map suddenly cared very much about British home loans. Because in finance, when one cockroach runs across the kitchen floor, you don't just kill it. You turn on the lights, and you start wondering how many are behind the walls. This is the story of how the collapse of a UK mortgage lender shook global markets, and why some investors are quietly asking whether this is just the first crack in a much larger credit cycle. It sounds dramatic, but the math underneath it is surprisingly simple and a little uncomfortable. Let's start with why this matters at all. The United Kingdom is not the United States. Its banks are smaller, its housing market is smaller, its mortgage system is structured differently. On paper, a single lender going under shouldn't ripple across the Atlantic. But finance today isn't organized by geography. It's organized by exposure. If you strip the logos off the buildings and look at balance sheets, what you find is a dense web of borrowing, lending, securitizing, hedging, and repackaging that stretches from London to New York to Frankfurt to Tokyo. When a UK mortgage lender collapses, it's rarely just a UK story. It's a credit story. And credit stories travel fast. Here's what happened. The lender in question specialized in residential mortgages. It wasn't reckless in the cartoonish sense. No executives buying yachts with depositors' money. No obvious fraud. What it did have was a portfolio heavily exposed to borrowers who refinanced during the ultra-low interest rate era. In 2020 and 2021, money was essentially free. Central banks, including the Bank of England and the Federal Reserve, slashed rates to near zero. Governments flooded economies with liquidity. Home prices soared. Mortgage lenders competed aggressively. 5-year fixed rates under 2%. Cheap funding in wholesale markets. Investors hungry for yield. It felt safe until rates didn't stay at the 2%. Fast forward to 2024 and 2025. Inflation proved stickier than policymakers expected. The Bank of England kept rates higher for longer. The Federal Reserve did the same. Mortgage rates reset dramatically higher. And in the UK, unlike in the US, most mortgages aren't locked in for 30 years. They reset every few years. That's a critical difference. In the United States, millions of homeowners are sitting on 30-year fixed mortgages below 3%. They're insulated. In the UK, many borrowers are exposed to refinancing risk. When their fixed term ends, they face whatever the market rate happens to be. For some households, that meant monthly payments jumping 30%, 40%, even 60%. And if you're a lender whose business model depends on borrowers smoothly refinancing, that's a problem. Because when payments rise sharply, delinquencies follow. Not immediately, but gradually. First come missed payments, then arrears, then rising default projections. At the same time, funding markets tightened. The lender didn't fund itself primarily through sticky retail deposits like a traditional high street bank. It relied heavily on wholesale funding and securitizations, bundling mortgages into bonds and selling them to investors. When confidence is high, that works beautifully. When investors get nervous, spreads widen. Suddenly, rolling over short-term funding becomes expensive or impossible. And this is where Wall Street enters the picture. Many of those mortgage-backed securities weren't sitting in some quiet pension fund in Leeds. They were held by global asset managers, hedge funds, insurance companies, U.S. money market funds. Credit doesn't respect borders. As news of rising defaults and funding stress spread, the market started repricing not just that lender, but the risk profile of similar assets. Bank stocks dipped because investors began asking a broader question. If a relatively small UK lender is under stress, what about others with similar exposure? And that's where the cockroach metaphor comes in. It's an old Wall Street saying. When you see one problem in credit markets, it's rarely alone. Not because every institution is fraudulent, but because they often share the same underlying assumptions. Let's unpack that. For more than a decade, global finance operated under a powerful belief. Interest rates would remain low indefinitely. Central banks reinforced this with forward guidance. Quantitative easing compressed yields across the curve. Investors reached for yield wherever they could find it. Mortgage lenders structured products assuming stable funding markets and manageable refinancing risk. Asset managers bought mortgage bonds assuming default rates would remain contained. Banks modeled their capital buffers using historical stress scenarios from a low-rate world. Then inflation arrived. Rates moved higher, faster than almost anyone predicted. And suddenly, business models built on cheap money had to operate in a world where money costs 5%, not 1%. The UK lender that collapsed wasn't uniquely reckless. It was highly sensitive. Sensitive to rate resets, sensitive to wholesale funding, sensitive to housing price stagnation. When home prices are rising, refinancing stress can be masked. Borrowers can sell, refinance, or tap equity. When prices stall, or fall, the options shrink. Now zoom out. The UK housing market has cooled. Transaction volumes are down. Price growth has flattened in many regions. In the US, the situation looks different on the surface. Most homeowners are locked into low fixed rates. That creates stability, but also freezes the market. Few people want to sell and lose their 2.7% mortgage for a 6.5% one. So supply stays tight, prices remain elevated, but beneath that stability, other parts of the credit system are feeling pressure. Commercial real estate, private credit funds, regional banks with concentrated exposure. When investors saw a UK mortgage lender fail, they didn't just see a British housing problem. They saw a reminder that higher rates are still working their way through the system. And rate hikes are like delayed charges. They hit slowly, then all at once. Consider the timeline. Central banks began hiking aggressively in 2022. It's now 2026. That's 4 years of higher rates filtering through loans that were structured in a different environment. Corporate debt refinancings, adjustable rate mortgages, short-term commercial loans. Many of these reset on multi-year cycles, which means the stress shows up with a lag. That lag is what makes markets nervous. Because it creates uncertainty. No one knows exactly where the weak links are until one snaps. After the UK lender collapsed, credit spreads in similar mortgage-backed securities widened. Investors demanded higher yields to compensate for perceived risk. That repricing affects more than one firm. It increases funding costs across the sector. If you're another lender with similar exposure, your cost of capital just went up. Even if your borrowers are performing fine today. And higher funding costs squeeze margins. Squeezed margins reduce profitability. Lower profitability erodes capital buffers, and thinner buffers make markets even more sensitive to bad news. It's a feedback loop. Now, to be clear, this is not 2008. Back then, the global banking system was stuffed with toxic subprime mortgages, thin capital ratios, and opaque derivatives. Today, large banks are better capitalized. Stress tests are stricter. Underwriting standards are stronger. But credit cycles don't need fraud to cause pain. They just need mismatched assumptions. In this case, the mismatch is between long-lived assets, like mortgages, and the short-term cost of funding them. When rates were near zero, that mismatch was manageable. At 5%, it's more complicated. Another layer of tension comes from investors who have piled into private credit over the last few years. Private lenders stepped in as banks pulled back, offering loans to companies and real estate projects at attractive yields. Trillions of dollars flowed into these funds. But private credit is less transparent. Valuations are smoother. Losses can be slower to show up. If funding stress in public markets intensifies, it can spill into private markets through liquidity pressure. And that's what Wall Street is watching. Not just a failed UK lender, but the possibility that we're entering a phase of the cycle where credit cracks appear more frequently. One in UK mortgages, maybe one in US commercial real estate, perhaps stress in leveraged corporate loans, none catastrophic on their own, but collectively, destabilizing. Think of it like structural fatigue. A bridge can withstand years of strain. But if multiple stress points weaken at the same time, confidence erodes quickly. The irony is that central banks are in a difficult position. If they cut rates aggressively to relieve pressure, they risk reigniting inflation. If they keep rates high, more borrowers face refinancing cliffs, and markets hate uncertainty more than they hate bad news, so they watch for clues. After the collapse, analysts immediately began scanning earnings calls from other UK lenders. How exposed are you to high loan-to-value mortgages? What percentage of your book resets this year? How much wholesale funding do you rely on? The same questions are quietly being asked in the US.